Welcome to NYSC Euronext, NYSC ARCA options, Amex options, webcast, introducing complex orders with an equity leg and expanded risk mitigation controls. I am joined by the illuminating Amy Farnstrom, and I'm your host, Todd Wilemon. A couple of housekeeping things to get out of the way. First off, there's a magnifying glass at the bottom right corner of your screen. You can use that to make the screen bigger or smaller. Also, there's a text box at the bottom of the screen, and any questions you have during the webcast, please type them in and send them to us, and we will answer them at the end of the show. Here's our disclaimer. Realize before we get started, these risk mitigation mechanisms that we are going to be talking about today are subject to the SEC rule filing process, and they may be modified in connection with that process. But this is what is into the SEC currently, and this is what we expect it to look like. Also, this is all copyrighted, and it's our stuff. So our agenda today, and cannot be used without our written express permission. So our agenda today is we're going to talk about complex orders with the equity leg first, and then we're going to talk about transaction-based risk mitigation for orders, and then we're going to talk about volume-based risk mitigation for both quotes and orders, percentage-based risk mitigation for both quotes and orders, and then we're going to answer any questions. So complex order book is expanding, Amy. So we have the 5 legs currently, and now one of those legs can be an equity leg. This is good stuff.
Yes, and we're really excited about this, Todd. It's been, as you know, a long time coming, and really is an absolute layup for us from a system standpoint. The options matching engines and the equity matching engines are extremely co-located inside the MAWA data center, and so in terms of execution opportunities, timeliness, all of that good stuff that comes out of that extreme co-location is going to be part of this, and we think it's a significant leap forward for the complex order book for us, and we're really excited about it.
Excellent. So this is going to be a little bit of a repeat for some people that are already in our complex order book, but there's 4 ways that a complex order can interact with our complex order book. You can send in just a regular complex order with an equity leg. You can send in a PMP plus complex order with an equity leg. You can send in a complex order with an equity leg for a complex order auction, a price improvement auction, and then a PMP plus complex order with an equity leg marked for complex order auction.
Yeah, and I think it's worth it to go through all of these 4 once again and just remind folks of the functionality and that it does, as you say, come with the equity leg.
So the first thing, send in a complex order with an equity leg. Now, before we get started, obviously you need an OTP or an ATP trading permit to trade either on ARCA or Amex, and hopefully everybody on the call will have both. And to trade this equity leg, you are also going to have an exchange trading permit with NYSC ARCA, an ETP ID.
That's correct. Once you have that paperwork in place, you can go ahead, and hopefully folks do already have that paperwork in place. You can go ahead and start sending in the orders. With the complex order at any net price with the equity leg, remember that it can trade inside the complex order book versus another complex with equity order that's been entered, or it can interact versus the options leg market plus the equity outright market. And again, this is where we're excited about having the options and equity matching engines so closely co-located, because the latency between the 2 systems is negligible. I mean, it's really next to nothing. And so if you are going to send in an order that is going to trade against the outright market, we will take a quick look at what's going on in the equity markets. If there's an execution opportunity that presents itself at the net price for the complex order or better than the net price for the complex order, we'll go ahead and send a fill or kill order to the equity matching engine. If we get a fill back, those option legs are waiting, ready to trade, and so it's a risk-free execution all the way around, and then you get your fill back. Obviously, you can also trade against a contracided complex order, and in that case, the equity component goes over to the ARCA equities matching engine as a cross.
Okay, so two quick questions. So now if you trade with another complex order, that's going to be complex order rates. And then if you get legged out and you trade against the individual legs, that's going to be our standard take rate, correct?
Well, so it will be standard transaction fees on the options platform, the take rate on ARCA and the standard transaction fee on Amex. Then going over to the equities platform for the fill or kill order, it'll be the standard take rate on ARCA. If it trades against another complex order, though, just something that our friends on the equity side have agreed to is that the crossing transaction on the equity side is free of charge.
Oh, that's great. Free of charge, I like that. Okay, so that's our first one, and that's just our basic standard complex order, no special modifiers.
No special modifiers. That's if you if you need the timeliest possible execution, maybe price improvement over the outright markets isn't as important to you, but you just want to get the trade up and done, then that is the choice that you want to make out of the four.
And then our second one is a PMP plus complex order at any penny increment. And this will actually float the complex order one minimum price variation, which is 1 penny, back from the derived BBO market.
Right. So basically what this and guarantees is that on whatever your ratio is, it's not going to trade against the leg markets. This is probably more compelling on the ARCA side of the equation than the Amex, because then you don't pay those take fees on each leg. You're guaranteed the complex order rate on the options legs. Again, the equity cross would be free of charge, and you get guaranteed price improvement over the outright market.
Okay. Mentioning ARCA, I know that in the latest fee filing, they decreased their rates for complex orders from 10 cents to 6 cents for all orders, no matter who they are.
That's right. We made some changes. We did do away with the same firm trading for free. We did lower the inter-firm rate to 6 cents. And I think the more compelling thing here, too, is that for those of you that are interested in hitting some customer posting tiers, your activity in the complex order book now also counts toward that. So that's kind of an additional incentive to, or an additional way to meet those tiers.
Excellent. Coming into the pool. Come on into the pool of the complex order book here. Or, of course, on the Amex also, because we love those people in New York. So now our third way to do this is a complex order with an equity leg mark for complex order auction. And so you have to have within the complex order auction parameters, which is the order, the price of the complex order has to be within the derived BBO. It can be on the derived BBO or within the derived BBO for it actually to qualify for a complex order auction.
Right, and when we say that, I mean, obviously if it's more aggressive than the contra side derived BBO and marked for COA, you're still going to have the opportunity for price improvement. If it's less aggressive than the same side derived BBO, then it will cancel back to you. But if it meets the COA parameters, we generate an RFQ. The information goes out, including the equity leg, and that gives folks the opportunity to come back in and respond with a contracided order that includes the equity leg. And again, in those circumstances, we would send the cross to ARCA Equities matching engine for a crossing transaction that would be free of charge. If you just send it in this way, just marked as a COA, if at the end of the transaction, obviously you can post to the book, the complex order book, you can trade against the leg markets if it's marketable, and so folks should just be aware, you get the opportunity for price improvement. If at the end your entire order hasn't been traded against, it'll post to the book or trade against the legs.
Okay. If you have no other modifier, but if you have like a time and force GTX, it will cancel at the end of the auction offer.
That's correct.
Okay, because I did not put that on the, I do not see that on the screen. And then the last way would be you have a complex order auction and it is marked PMP plus complex.
Right, and so this is just sort of the full service package or a full service choice, right? You are not going to trade against the leg markets. You get the opportunity for, significant price improvement based on what the responses are coming back from the RFQs. And if any balance is remaining at the end of the complex order auction, you're still guaranteed price improvement over the leg markets. You're not going to trade against the leg markets.
And so it'll always post that penny back. Now, an interesting thing with the PMP Plus Complex, all complex orders going into the complex order book have to have a penny price, except for PMP Plus Complex orders. Those can actually be at a market.
That's correct, because we obviously do not want someone to inadvertently trade against some wide leg markets. The SEC has allowed $5 wide markets in the outright series during core trading in less active issues.
Mm-hmm.
There are some wider markets, and so we prefer that if people are going to enter an order that can trade against the legs, they tell us the maximum limit that they're willing to trade at. The PMP Plus, because that price protection is built into the order type, if you just want to put in a PMP Plus order and know that it's going to float at a very aggressive but price-protected price for the rest of the day until it gets filled, then the PMP Plus market order is a good choice.
Excellent. Good to know. So come on into the complex order book, people, with your equity leg complex orders. Okay, so let's go on to risk mitigation. Now this is exciting. We already have risk mitigation in production for market makers on their quoting, and that's called our transaction-based. So tell us about transaction-based risk mitigation that we currently have right now.
Yeah, transaction-based risk mitigation is battle-tested. It's been in production for several years and has provided healthy price protection or risk protection for our market makers with their quotes. What the minimum has been over the past several years since it's been in production is 5 transactions over a rolling 1-second timer period. We do have a rule filing at the SEC to lower that minimum to 3 transactions over 1 second, and we're hoping to have approval there from the SEC in short order. What is exciting and new in this upcoming release is that we're extending the same protection that we have in production for quotes to orders. So we'll have transaction-based risk mitigation not only for quotes but now also for orders.
Wow! And so you can have you have risk mitigation for quoting, and now we're going to start having risk mitigation transaction-based for orders also. Now that's not for just any order. That's going to be for a PMP order type.
Yes, it's for all the PMP order types for single leg orders. This does not include PMP Plus for complex that we were just talking about. But this is geared for participants, order sending firms that come to us over ArcaDirect and have a large volume of orders that they're sending to us that are the PMP order types. There's PMP, there's PMP blind, and there's PMP light only. Those 3 order types are covered by this functionality.
Okay. And that is ArcaDirect, and the specs for ArcaDirect 4.1 are on the trader updates that I've sent you, and the trader updates talking about risk mitigation on our website at nysc.com, and it's on the right side. Just look for the trader updates for either ARCA or Amex, and there's a link to that. Here's an example of our transaction-based risk mitigation. So you have the 1-second rolling time period. You have 5 transactions, which are 5 individual orders. So it could be a 1 lot or it could be a 500 lot, right?
That's right. This is based on transactions rather than on contract count. We'll get into contract count when we're talking about the other flavors that are coming. This simply means that, for whatever size of quote or order that you have out there, the full size is exposed, firm quote rule, but based on the number of transactions that you incur, your quotes or orders get pulled.
Excellent. And that's just specifically per underline. All of these risk mitigations are per underline?
That's right, yes. And so for market makers, it is a requirement that they have one type of risk mitigation in place. For the order sending firms, it's purely optional. But it is on a per underlying basis.
Okay. And then our second one, and you were just talking about that, the volume-based risk mitigation. Now, this gives it a little bit more granularity. This is really seems a nifty way to manage your risk. So you have it's not so much the trades, it's now a number of contracts that you're trading.
That's correct. So if you have a set number of contracts that you're comfortable being executed against in a rolling second timer period, you can set that contract count. The default is 500 contracts. This is for market maker quotes. The minimum level of contracts is 20. The maximum is 5,000. You know, one thing to note here is that the new risk mitigation mechanisms are backward compatible. Mm-hmm. So that means if you are currently on your current Market Maker Direct API or you're on your current Arca Direct API, you don't have to make any changes. Mm-hmm. You know, we're going to roll this out. It's client choice. If you do want these new features, then you need to upgrade. Mm-hmm. And as you said, the specs are on the website. The specs are on the website. Now, if you're going to upgrade, our CERT environment is open also. That's a trader update out there that we sent y'all 2 weeks ago. And there's testing scripts for all your testing needs. And, of course, you can always contact firm testing at firmtesting@nyx.com, and they can set you up. So a quick example of the volume-based RM. So during that 1 second rolling time period, you have 500, let's say it's set at set to 500 contracts per 1 second, and this is underlying specific again. Yes, it is underlying specific, and one thing that I want to be really clear about with the volume-based risk mitigation is that we say that you set your threshold to 500 contracts. You know, once you enter into the transaction that's going to push you over that 500 contract maximum, your quotes or orders will get pulled. But obviously, we're not going to violate firm quote rule. Mm-hmm. So the size of the final transaction, right, that final transaction, if you are sitting at 440 contracts in the rolling second timer, and you've got an order or a quote out there for 100 contracts, mm-hmm. We're not going to pull it after the first 60 of that 100 lot. So the size of that last transaction determines your total risk. Oh, that's good to know. Right, but right. We just don't want to get in any trouble on the firm quote side of things, and I think that's just sensible. Right. But just understood that, you know, it's not going to go beyond that final transaction that pushes you over the breach. Right, but so it'll be, your firm quote, which totally makes sense. But that's good to make sure that everybody understands that. And then our last one is percentage-based risk mitigation. And so this looks like it's going to be more for orders comfortably than quotes, but it can be for both. So, no, I would say that it could be for either one, absolutely. You know, this is for folks that may quote more aggressively in the front months than the back months, or vice versa, and they have a lot of different order sizes or quote sizes in the market, and it's really not based on contracts, so it's not based on number of transactions, but it's the percentage of your total exposure that you're comfortable with. Mm-hmm. So if you say, you know, I'm comfortable. Let's just move to the example. Mm-hmm. If you say that I am comfortable having 300% of my quoting interest out there, then that could be different sizes on each quote or order, but it's going to look at the transaction that occurs against the total percentage. So it could either be 100% of 3 quotes if you're set at 300. It could be 50% of 6 quotes, 30% of 10 quotes. That gets counted with the understanding that final transaction that pushes you over the breach, right, is going to be 100% of that quote or order. Of that, quote or order. Now that's a lot of calculation. To even just one underline for all the theories that are out there. Thank goodness for computers, right? Yeah, thank goodness. I'd hate to be on the chalkboard trying to keep track of this. I mean, when you're looking at some underlines with, 20, 40, 50 series. And but I have to tell you, this is in CERT right now, and it's working like a charm. It looks really great. I think quoters are going to really like this. Yeah. Yeah.
Wow.
And just to be clear, this is for both quotes and for P&P orders as well.
Mm-hmm. So now, this is each of these risk mitigations are per underline. So can a market maker use different risk mitigation mechanisms for his individual underline?
Absolutely. So the only requirement for market makers is that they select one of the three for each underline. But it's not a global decision, so it's up to the firm to decide based on their risk profile. Hey, in issue XYZ, the contract-based risk mitigation seems like it's going to work for us the best, but in issue ABC, we've had the transaction-based, it works really well. We're going to stick with that. That's totally fine. They're going to be enabled at the beginning of the day with transaction-based risk mitigation. So as a market maker, you come in, you're required to have something in place. We're taking that first step for you. So the default is transaction-based risk mitigation. Then when you come in to send in your quotes, you can select any type of risk mitigation and the threshold that you're comfortable with for each underlying.
Wow, that's excellent.
And you can change it on the fly.
And you can change it interday. Yeah. And yourself, right? Because this is going to be, you don't have to call the trade desk.
It's over the API.
Right. But you can call the trade desk and talk to Brandy Patterson anyway, because she does like to talk to them.
And who doesn't want to talk to Brandy?
Exactly.
He's
totally
awesome.
Agree. So a couple of general rules. Oh.
Yeah. So I'm sorry, I jumped ahead of you here.
No,
I'm on the general rules. We went over the market makers. Should we talk about the trading permit holders for the orders?
Yeah, let's talk about that. So now that's not going to be a requirement. So if you're sending in orders, you're not going to be required for risk mitigation.
No.
But since we're offering it to you.
That's right. And it is, we try to make these changes and prioritize them based on client requests. And we have had, quite a few of our order sending firms that use ArcaDirect that send in the P&P order type have requested this. And, we're a big believer in a level playing field, making these risk controls available to all our participants. On the flip side, in a release later this year, we're going to introduce the concept of quote types, right? So we won't just have order types, we'll have quote types. The same concept applies here. The other thing to point out here too, though, is if you have a market maker that's sending in, a lot of our market makers send in quotes, and then maybe they'll layer the book with orders, right? And again, if you're layering the book with P&P order type over ArcaDirect, you've got market maker quotes in the system, you've got orders in the system. You can have risk mitigation on for the orders or not. If you do have risk mitigation on for the orders, it doesn't have to be the same type of risk mitigation as you have for quotes, even in that same underlying. These are two distinct mechanisms.
Right. And I'm glad you mentioned that there are two distinct mechanisms as the large truck goes by our studio. Two distinct mechanisms, and the key on that is they're not going to talk to each other, even though they are going to be for the same underlying.
That's correct. There's no cross-aggregation, so we're not going to mingle order count with quote count and come up with some aggregate volume number. That's a question that we've gotten from a few folks, and just the way our system's architected, it's just a lot cleaner to keep quotes to quotes and orders to orders, and never the twain shall meet when it comes to risk mitigation.
That makes sense. Keep everything quick and fast. And then the last thing that we have up there is our last rule is once the threshold has been breached on market maker quotes, they get pulled, or if it gets reached on P&P order types, those P&P orders get pulled. But not all orders will be pulled.
Yeah, so for our market making friends, this is familiar, right? Because this is no change from what's in place now with the transaction-based risk mitigation. We pull you. We want to know from you that you are happy to be back in the market. You're ready to, put your lives on the line, accept more risk, right, like you do all day long. For our order sending friends, this will apply to your P&P orders as well. Your orders will get pulled. Before you send us any more P&P orders, we want to know from you that you're ready to go. Non-P&P order types. So if you have day orders in, or GTC orders, or you want to send in IOC orders, those orders are not subject, if they're not marked as PNP, they're not subject to the risk controls. And for those trading firms that send in PNPs, and then they also want to send in and take out interest, with an IOC order, just realize that while your PNP orders have been pulled, and before you enable your PNP orders again, you can still send in IOCs. So that never gets stopped.
Okay.
So it's just a little bit of a nuance there, but it's something that, based on feedback that we got from clients, we thought was the cleanest way to go forward.
Oh, sounds very robust. So now we're on to our question time.
So it looks like we got a few questions here. I've got a question: what's PNP and what's PNP Plus? I suppose since we've been throwing those terms around for the entire webinar, we should probably just let you guys know what PNP and PNP Plus are. PNP simply means post-no preference. It is a term that was brought over from the ARCA equity side of the business. Another way to say it, it's a do not route order.
Orders stay on our exchange.
That's right. So the different flavors in the outright markets is the regular PNP, which if you send it in and it needs to route, it will just cancel back to you. We have the PNP blind, which if it needs to route, it's going to go blind at the NBBO price, so it doesn't lock or cross the NBBO, but it's not going to cancel back to you. You still get a posting credit, right, because it's resting on the book. And then the PNP LO is kind of the opposite side of the equation with the PNP blind. PNP LO will only trade against light interest. That's why it's the PNP light only order type. So if you're going to come in, you think that you're adding liquidity, you inadvertently bump into something that's blind, you're going to get it canceled back to you. It won't route out. So those are the PNP order types for the outright markets, for the single leg market. For the complex order book, that PNP Plus, we leverage that PNP terminology because it doesn't route out to trade against the legs. It stays inside of the complex order book.
Everything makes sense.
So now we've got a question, increments of 3 instead of 5. So that means the minimum setting is going from 5 transactions over a second down to 3 transactions over a second. Yes, we certainly hope so. Yeah. That's in front of the SEC right now.
Right. Everything that we've talked about today, we are awaiting final approval by the Securities and Exchange Commission. Again, it was at the front of our broadcast, and I know the lawyers that are still on the call would be happy that it's at the end of our broadcast also. Good question.
Is the risk mitigation related to complex orders? I do believe we touched on that. It is only for the outright markets. For those of you that are listening and interested in the complex order book and some risk controls there, I'm happy to report that we are in the process of working on a 2 executable filter for the complex order book that we think is going to be pretty darn nifty, and that will be coming later in the year.
Because the complex order book is still expanding. There's a couple of things that are going to be coming out of it.
Yeah, there's lots of good stuff coming there. Okay, let's see. Do we have any other questions coming in?
So a couple of things. You can give everybody a couple of minutes to send, or give everybody 60 seconds. Type quickly. You can catch a copy of this website, this webcast on our website. It's going to be at nysc.com, or you can go to either one of the NYSC ARCA options or NYSC Amex options. Look on the right side of the screen, look for market services, and then you'll see a link that says option webinars, and this will be up on the website Friday.
And, the other thing, just to reiterate, because we went over it, but I just want to make sure that folks are really clear. If you want this risk mitigation on your PMP orders, you do need to code to ARCA Direct 4.1. Okay? You don't have to. This is optional, but if you want these protections, go ahead, The specs are posted on the website. Todd referenced the trader notice where all the information pertaining to this stuff is. Check it out.
Our CERT environment is open right now.
Yep.
We have test scripts for order types, risk mitigation, ready to use, firm testing at nyx.com. They're ready to help you walk through, and very helpful people at firm testing, and that are going to go through the CERT environment. We're really excited about it, and we'd love to have everybody test on it and use this PMP for order.
Yep. And same thing with the market maker quotes. You know, if you're happy with the transaction base, you know, that's good. We're awfully pleased that it's working out for you. But we do have the additional flavors now. We're excited about them. So come test with us, and we are going to be rolling this out throughout July. We'll roll it into production with the code turned off. Boo, hiss, why are we doing that? Well, we have to get it approved by the SEC before we can turn it on. And we will definitely keep you posted as to the expected timeline for that SEC approval.
Sounds good, Amy.
Todd, well, it's always a pleasure.
It is always a pleasure, Amy. Everybody, trade them up here at NYSD Euronext. And you can follow us on Twitter at NYSD_option.
And one last question came in under the wire, and I want to answer it. The expected date to launch Complex with the equity leg will be in that July time frame. We're going to do a 3-week rolling deployment to all of our matching engines. So, we're hopeful to be completely live on all matching engines on ARCA and Amex by the end of July. And again, we will definitely keep you updated via trader notice. Todd puts those out always in a timely manner, and we'll keep communicating. Last thing, send us an email if you have any specific questions that we weren't able to answer today.
Excellent, Amy. Thank you so much.
Thanks, everybody.
Goodbye.